The car market has completely changed. The Fed increased interest rates. So as a buyer, yeah, things are negotiable again. Car dealerships are in trouble. Car dealers are going to die. Be careful. Just like those profits just must have been out of this world. I'm quite envious on the new car stores. Oh, the sky is falling, the world is collapsing, the car market is collapsing. What are we all going to do?
The once mighty American car market, long a symbol of the nation's economic vitality and consumer confidence, is showing alarming signs of a slowdown, if not an outright collapse. The warning lights are flashing red as sales plummet, inventories pile up, and consumers increasingly shy away from the new car lots. This is not a mere blip on the radar, but a fundamental shift that threatens to upend one of the most essential pillars of the U.S. economy, with far-reaching consequences for workers, businesses, and communities across the country. The numbers paint a stark and sobering picture. U.S. new vehicle sales of 1,327,976 units for the month of April represented a decrease of 8.1% from March and a decrease of 2.4% from 1 year ago in April 2023. There were 25 selling days in April 2024, one less than the 26 days in April 2023. April's passenger car sales decreased from 10.7% to 264,482 units, resulting in a 19.9% market share, while SUV and truck sales decreased 0.1% to 1,063,494 units, underscoring the accelerating pace of the slowdown. The carnage is widespread, affecting automakers across the spectrum. General Motors, the nation's largest automaker, saw its U.S. sales plummet by 33.2% in the first quarter of 2023 compared to the same period a year earlier, while Ford sales fell by 18.4%. Even Toyota and Honda, long bastions of strength in the U.S. market, saw their sales drop by 22.6% and 28.3% in the first 3 months of the year. 2022, however, was the worst year in more than a decade for the auto industry amid vehicle shortages and sky-high prices. Supply chain issues, a shortage of crucial semiconductor chips, high interest rates, and low inventory made car sales tumble. Only 13.7 million vehicles were sold in 2022, a drop of 8% from 2021 and the lowest total since 2011. From all indications, the American car market has clearly seen better days and now teeters on the precipice of economic regression. The once revving engines of prosperity are sputtering and the open roads of opportunity are narrowing. The market finds itself at a crossroads where every turn could lead either to a revival or to an even steeper decline. In this video, we will explore the factors behind the sudden slowdown and potential collapse of the car market in the USA. The auto industry is a key driver of consumer spending, which accounts for more than 2/3 of U.S. economic activity. Americans, on the other hand, place a high value on car ownership, a fact made evident by the latest car ownership statistics in the U.S. A total of 278,870,463 personal and commercial vehicles were registered to drivers in the U.S. in 2022. Between 2018 and 2022, personal and commercial vehicle registrations increased by 3.5%. Indicating an upward trend in car ownership. Most U.S. households, or 91.7%, had at least one vehicle in 2022, and 22.1% of households had 3 or more vehicles. Historically, the car market has been a pillar of the American economy, a symbol of the nation's industrial might, technological prowess, and consumer culture. In the boom years of the 1950s and 1960s, the big 3 automakers, General Motors, Ford, and Chrysler, dominated the global industry, churning out millions of vehicles a year and providing a pathway to the middle class for generations of American workers. Even in the face of oil shocks, foreign competition, and changing consumer tastes, the U.S. car market has remained a formidable force. As recently as 2015, automakers sold a record 17.5 million new vehicles in the United States, a testament to the enduring appeal of the American love affair with the automobile. However, when consumers pull back on big-ticket purchases like cars, it can have a chilling effect on the broader economy, as businesses cut back on investment and hiring, and households tighten their belts in the face of rising uncertainty. In recent years, there have been signs that this once unshakable foundation is starting to crack. Even before the COVID-19 pandemic threw the industry into turmoil, U.S. auto sales had begun to plateau as consumers grappled with rising prices, longer loan terms, and growing concerns about affordability and sustainability. As a matter of fact, high vehicle prices and high interest rates remain the industry's Grinch right now. In 2019, the average price of a new vehicle in the U.S. hit a record high of $38,948, according to Kelley Blue Book, a 3.5% increase from the previous year and a staggering 29% jump from a decade earlier. At the same time, the average loan term for a new car stretched to a record 70 months as consumers struggled to keep up with rising costs by spreading payments out over a more extended period. The pandemic only accelerated these trends as supply chain disruptions, chip shortages, and shifting consumer priorities upended the industry. In 2020, U.S. auto sales plunged by more than 30%, the sharpest annual decline since the Great Recession, as lockdowns and job losses took their toll. While sales rebounded somewhat in 2021 and 2022, they remained well below pre-pandemic levels as the industry grappled with ongoing production challenges and changing consumer behavior. Now, as the economy faces a new set of headwinds from stubborn inflation to rising interest rates to growing fears of a recession, the car market is once again in the crosshairs, and the signs of trouble are mounting. One key factor is the seismic shift in consumer preferences away from traditional cars and towards larger, more versatile vehicles like SUVs, crossovers, and pickup trucks. According to recent data, light trucks, which include SUVs and pickups, accounted for a record 79% of new vehicle sales in the U.S. in 2022, up from just 51% a decade earlier. This shift has put enormous pressure on automakers to retool their production lines and portfolios, even as they grapple with the challenges of electrification and automation. Car dealers had to offer generous incentives and discounts in December to clear older inventory after 2 years of holding back on promotions. But even within the light truck segment, there are signs of trouble. In the first quarter of 2023, sales of full-size pickup trucks, long a cash cow for American automakers, tumbled compared to the same period a year earlier. The U.S. auto industry has witnessed its first back-to-back first-quarter sales gain since the Obama administration, heralding a positive rebound. However, amidst this resurgence, the segment of large pickups has shown a downturn, marking a 4% decline from January through March this year. This is particularly problematic as pickups are among the most profitable vehicles for automakers, and a slowdown in this segment could have outsized impacts on the industry's bottom line. Another key factor is the ongoing chip shortage, which has forced automakers to idle production lines, cut features, and raise prices in the face of limited supply. According to a report by Alex Partners, the global auto industry lost an estimated $210 billion in revenue in 2021 due to the chip shortage, and the problem is expected to persist well into 2023 and beyond. This shortage has hit automakers at a particularly vulnerable time as they seek to ramp up production of electric vehicles, or EVs, to meet the growing demand and regulatory pressures. EVs require significantly more chips than traditional internal combustion engine vehicles, putting further strain on an already stretched supply chain. But perhaps the most significant factor behind the car market slowdown is the broader economic environment, which is becoming increasingly challenging for consumers and businesses alike. Inflation remains a lingering nemesis that is fast becoming synonymous with the American economy. Inflation, which has been running at a 40-year high in recent months, is eating away at household budgets and making big-ticket purchases like cars less affordable for many Americans. According to the Consumer Price Index, the cost of a new vehicle rose by 0.4% in April 2023 compared to a year earlier, while the cost of used cars and trucks soared by 22.7%. This puts enormous pressure on consumers who are already grappling with rising costs for essentials like food, housing, and healthcare. At the same time, rising interest rates are making it more expensive for consumers to finance car purchases, further eroding affordability. According to Experian's State of the Automotive Finance Market report, the average auto loan interest rate for new cars in 2024's first quarter was 6.73% and 11.91% for used vehicles. This means that consumers are paying hundreds or even thousands of dollars more in interest over the life of a car loan, on top of the already high sticker prices. For many Americans, particularly those in lower and middle income brackets, this combination of rising prices and financing costs is putting a new car purchase out of reach. A recent survey found that 1 in 4 Americans has delayed a vehicle purchase due to higher interest rates, with younger and lower income consumers being most likely to put off a purchase. This is a worrying sign for the industry, as a prolonged slump in demand could have cascading effects throughout the supply chain, from parts suppliers to dealerships to service centers. It could also exacerbate existing inequalities in the economy as wealthier consumers continue to snap up high-end vehicles while lower-income households struggle to keep up with rising costs. There are also longer-term structural challenges facing the industry, from the rise of ride-sharing and subscription services to the growing importance of software and connectivity in vehicles. These trends are upending traditional business models and forcing automakers to rethink their strategies for the future. One key question is whether the current slowdown is a temporary blip driven by supply chain disruptions and pandemic-related volatility, or a more fundamental shift in consumer behavior and economic conditions. Some analysts argue that pent-up demand from the pandemic, combined with an eventual easing of supply constraints, could lead to a rebound in sales in the coming years. But others warn that the industry could be facing a more prolonged period of stagnation or even decline as consumers grapple with rising costs, changing priorities, and growing concerns about sustainability and urban livability. This could have far-reaching implications not just for the auto industry, but for the wider economy and society as well. In the short term, automakers and dealers are scrambling to adapt a new reality by cutting costs, offering incentives, and shifting production to better align with changing consumer preferences. Some are also exploring new business models, such as subscription services or direct-to-consumer sales, to try to offset declining traditional sales. However, in the long term, the industry will need to grapple with more fundamental questions about its role in a rapidly changing world. How can automakers balance the need for profitability with the growing demand for sustainability and social responsibility? How can they adapt to the rise of new technologies and business models while still preserving the jobs and communities that depend on the industry? And how can they continue to innovate and compete in an increasingly globalized and digitized marketplace? These are not easy questions to answer, and there will undoubtedly be winners and losers as the industry evolves. However, one thing is clear: the American car market is facing a moment of reckoning, and the choices that automakers, policymakers, and consumers make in the coming years will have profound implications for the future of mobility, the economy, and the planet. The once gleaming showrooms, now dark and forlorn, are a monument to the cruel ravages of unbridled inflation, a testament to the brutal reality that for far too many, the simple pleasures of life, the freedom of the open road, the pride of ownership, have been placed firmly out of reach. As the great American philosopher and essayist Ralph Waldo Emerson once wrote, "The future belongs to those who prepare for it today." For the auto industry and for all those who depend on it, the time to prepare is now, before the slowdown becomes a full-blown crisis. If you like this video, hit the like button and help us spread the word. And don't forget to subscribe to get notifications on our latest news and analysis. In the meantime, check out one of these videos here to learn more. Thanks for watching.